Firstly, thank you, Bharat Fintech Summit, Digital Fifth, for organizing this wonderful event and for giving us this opportunity to have this important conversation. I'll quickly jump into the topic. Over the last decade, actually, India has built financial access at an unprecedented scale. When UPI got launched, in fact, on 11th April 2016, it has actually fundamentally changed the way how India transacts. Today, supporting almost 400 million active users with almost 20 billion transactions on a monthly basis. Along this, we have also opened around 500 million Jandan bank accounts and almost near universal digital identity. Yet, access alone hasn't solved inclusion. From our experience at Dwara Money, working closely with the gig and the blue-collared workers, micro-entrepreneurs and first-time borrowers, we have seen relatively small design choices, that is, onboarding flow, documentation, and assisted journeys often determine whether a product is adopted or abandoned. This esteemed panel brings together perspectives across system design, product architecture, underwriting, and large-scale portfolio management. The objective is not consensus, but to surface what works in practice, where design has fallen short, and what leaders would do differently today. To set the system-level context, let me begin with Mr. Pawan Bakhshi. We'll start with the topic on, that is, the data as an inclusion lever. So the question to you would be, from a system-level perspective, how should India design inclusive financial infrastructure for the underserved and first-time borrowers using data and digital public infrastructure?
Thanks, Clemenston. Hi, everyone. Good afternoon. You know, data, they say, is the new oil, right? But unfortunately, for folks who deal in cash, there are no data trails, right? And that's what starts creating a problem, because a whole lot of people will still receive cash in their bank account and withdraw the cash and start spending it. But having gone and said that, it's not that they don't have the data. So either they are smallholder farmers and they have small pieces of land, or they are doing some other transaction, and those transactions are locked with institutions. What's the mode and methodology or a process or a policy that will unlock that and allow the customer to be able to share her data with the people that she wants to share them with? Right? Now that mechanism hopefully was the account aggregator ecosystem, which does work on the bank accounts yet, but not other types of data yet. So the RBIH is working on the ULI piece, where there's some levels of data that are coming in, but there's a lot of data that's locked in the ecosystem, including MFIs, who have a lot of data on their consumers. There are, other institutions, the telcos, the insurance companies, the other folks who have the data, but that's not available to the consumer to share yet in a consolidated way. I think the next phase of growth is going to come from consolidation of what data is available for the individual, and can that be shared by the consumer herself in a more meaningful, easily done way that allows her to get benefits of use of the data. And I think the digital public infrastructure and the data exchanges will be more user-friendly and will start emerging, because if the data cannot be stored in one single place, what are the APIs that can be used to interact with all the sources of data and allow that, kind of a map of a consumer emerge from the data that's available. So hence, I believe that for folks who today also still deal in cash, and I would not say new to credit, I would say new to formal credit, because a whole load of other people do get access to credit as well, but at really high interest rates and informal stuff. So how do you move folks from informal to formal is the question. And I think the role of data is key.
So when I was highlighting initially around 400 million users are active on UPI, right? But almost 190 million odd adults still are underserved with regards to credit. So
yeah, so I'll just unshackle that. You'll have to see this segment of customers. Out of the 400 million or 450 million odd people, how many of them are in this room, right? And how many of them actually are at the bottom of the pyramid who are able to use that in a way that I and you use it today, right? So in terms of segmentation, the more we go down and we ensure that this 450 million odd people go to about 800 million people, because 800 odd million people have a smartphone today in the country. So you essentially have half the population who has a smartphone is on UPI, but they all have a bank account today, right? So that is the transition that you need to make to get to the bottom of the pyramid, and the most vulnerable, sections, including women, who are unfortunately kind of left out always as the system grows. So we need to be far more inclusive in that. But I think the key is, can a lot more people start to use their bank accounts and smartphones to pay? And then you'll see the generation of data happening.
Sure. Great. Thank you so much for that. Building on that system view, let's now come closer to the underwriting engine itself, where inclusion and risk management often pull in opposite directions. So my next question will be to Kartik sir. As underwriting models scaled across underserved segments, where do you consciously trade off predictive accuracy to preserve explainability or inclusion?
Yeah, thank you, Clement, and thank you, BFF, for this opportunity. So I think to answer your question, there are 3 or 4 elements where you have to really kind of look at a trade-off and then see how it is kind of playing out. I think at a very basic level, it is accuracy versus inclusivity, right? That's the most fundamental question. And when you aim for accuracy through the digital systems, there is always a possibility of kind of bypassing the recency of data. So that is something which is a very critical element in the context of financial inclusion, because a lot of our customers are still in the process of establishing their digital footprint. So, I think it's very important that we look at this element. The second one is more in terms of efficiency versus fairness. So while, it gives a lot of efficiency in terms of cost optimization, improved collections, etc., there is always kind of, historical data might perpetuate a bias, which kind of can lead to exclusion. And that is something which one has to be extremely careful. That's the second point. The third element, I would say, is in terms of basically personalization versus data privacy, right? So at some level, with so much of alternative data available, so much of assisted distribution available, there is, you can customize products, right? Which also requires a lot of data mining, which then throws up the risk of privacy. And again, that's a kind of a balance that you have to kind of, establish. There are ways of mitigating that. You can possibly use explainable AI, which essentially will enable you to not use a black box approach to underwriting, but more in terms of being much more transparent to all your stakeholders. And I think that is one way of kind of doing it. The other way is there are algorithms which help mitigate the biases, particularly the demographic biases. Some of the communities have been much later coming into the mainstream financial inclusion, and you don't want data to kind of exclude them. And then of course the sensible use of ethical use of user data. I think that's probably the most burning question that all of us face globally. And I think DPDP is one of the steps towards that direction. So I think that's how I would summarize the balance.
Thank you. Since you're also at Pehel, since you're a large microfinance institution and financial institution there, what about, you want to throw some light on co-lending, what you do there?
Yeah, so I think I agree with Pawan that there's a lot of divergent data available in the in the universe. I think the trick is how do you triangulate that between, like, say, alternate data, the distribution, and ecosystem partnerships. And I think towards that, the regulator has come up with a very, very robust co-lending guidelines, which have just got implemented from Jan 26. Largely, co-lending was being looked at from a priority sector perspective, which has now been kind of done away with. There are very set rules in terms of, how the customer data has to be managed between the two partners. How NPA management happens at a kind of, and allocation happens at a customer level. Transparency in terms of the combined pricing. What kind of FLDGs, that has to be kind of given, how much percentage needs to be there. So I think the key really is the ecosystem partnership that this regulation will enable to forge. For us, I mean, we have been a much more conventional MFI, but over the last about a year or so, we have been able to form partnerships through the co-lending model, and therefore address a set of customers, financially excluded customers, which we would never have been able to kind of target otherwise. So I think there is a very very clear merit in terms of identifying your strengths and then being a part of the ecosystem.
Great, thank you so much. Recurring challenges, underserved markets is cash flows are real, but not always visible in formal data. So my next question will be to Mayur, who is the CEO for Moneybox. You've been doing a lot of interesting work there at Moneybox. What alternative data signals have been most valuable in understanding rural cash flows? And how do you validate them on the ground?
Thanks, Clement. See, when we started this, we were very clear in our minds that obviously we, with the amount of capital that we are starting this business, will not be able to compete with the big boys in tier 1s and tier 2s. The only way we could have built this business was kind of built it in, as was getting highlighted in the previous session, for the real Bharat. Now, the moment you enter real Bharat, there are a lot of challenges which come with that proposition. I think cash flows, one challenge. You don't have data to kind of corroborate, no banking details. Bureau is very, very sketchy. Everybody looks like new to credit, whilst he's not new to credit, he's new to credit from a formal perspective. I think it is important to reverse the lens and see whatever you get in terms of data points, can you build a model around that instead of going top down saying that, okay, fine, I have this. These are the traditional kind of channels and data points, and then build around that. Instead of that, look for cash flows, look for things which are available around that customer and see if you can build a model around that. Because we do a lot of cattle, livestock financing, and in the ecosystem, a lot of people have really burnt their hands in the cattle financing. But we said, okay, fine, we'll try and crack this model. In the initial days itself, we started hiring a veterinary doctors to kind of, corroborate some of the information in terms of what is the cattle, what kind of cattle it is, what is the health of the cattle, because there is no real tool available to kind of assess that. So kind of whatever customer segment you have, whatever data points you have, you build your model around that, and then develop a working model to be able to lend that, right? So I think one is that. The other thing is that, if you don't have a bureau, doesn't mean he's a bad customer. I think that is very, very important. It gives you some indication, doesn't give you full indication. So we lend to 400 scores, 500 scores, because a small mistake in repayment behavior for that customer really brings down his score. Doesn't mean that he's a bad customer. he's probably not aware of some of the data points that he need to be aware of from a financial literacy point of view. If he doesn't have a banking, doesn't mean he has no cash flows. He still has cash flows. He's not in the habit of depositing that into the banking that he has. Likewise, the reverse is also true. Just that because his score is 700 doesn't mean he's a good customer. There might be a lot of loans that he's carrying. He might be an over-leveraged customer. So you need to be able to look at both aspects of it. No data points and a lot of data points. You need to be able to make sense of those data points and then build your model around those data points.
Out of what you just mentioned, how much of it is human-led versus automated? Entire thing, because cash flows is very difficult to track. So how much of this will be moving into an automated way versus?
Now, yes. When we started, a lot of that was human intervention. We used to kind of ask the relevant questions, used to go into a app and then calculate it. But now, just to give you one example, because the fact that we lend a lot to cattle customers, I think the biggest problem is the identification of cattle. And how do you identify which breed it is, what is the milk yield, and so on and so forth. So we kind of invested in the technology, built one technology, which is mother technology. And now, through that, all the cattle onboarding happens within the system. So now that technology is helping us identify the cattle, the breed of the cattle, the age of the cattle, what is the probable lactating cycle of the cattle. So I don't have an human intervention there now. That helps in enriching the data, better underwriting, no matter what the loan officer or the credit officer might say. I have a technology now to corroborate that information. So that helps a lot.
So you're leveraging more on alternative data.
Absolutely, absolutely.
Great. Okay, so let's move on to the next topic, which is designing credit products around real customer behavior. So my next question will be to Kartik Mehta, sir. What are your thoughts on designing credit products for rural and semi-urban markets with customer-centered journeys, local distribution, and cash flow-based lending models that reflect real customer behavior?
Sure. So from our perspective, I think, there is a lot of kind of infrastructure, the digital infrastructure development that is enabling this. And I do tend to agree with what Mayur mentioned, that, it is very important to kind of, get the data together, what is available, and then kind of try and kind of, analyze. But again, if I have to kind of, analyze the four elements which go into the underwriting. One is, of course, the rise of the bank analyzer at a very basic level, right? I think that being said, while there is a lot of customers who are still not banking, but at a household level, I think we have an increasing footprint of how household behavior is shaping up to the bank account. I mean, the raw information that is there can be kind of transformed to kind of, arrive at an underwriting piece. The second, I think, a fundamental shift which all of us are kind of experimenting with, and there are some banking experts also in this room, is at cash flow not being the kind of, first, I mean, it was more of a second look, subservient to the credit score. But I think that is increasingly getting replaced. Cash flows are becoming much more, to the extent that they are available, but they are becoming very critical in analyzing a customer behavior and, more importantly, product design. So that's the second point. The third, at least in our context, because the customer segment whom we serve do not have as many footprints as maybe the MSME or the more kind of salaried, although informal salaried segment. We are evaluating, ML for a true predictive analysis, which essentially tells a lot of behavioral aspects of the customer, right? I mean, when you use it and kind of try and capture it, objectify it, it tells you, whether there was a third person intervention in the question, when the analysis is, the underwriting is happening, or, the tone, the body language, some of these things have started kind of getting implemented and IMA Ventures is here. I mean, they are at the forefront of some of these kind of, supports that we are looking at. I think the fourth, at the end of it, if you are able to, through smart APIs, look at embedded finance at a front end where the credit loan decisioning is happening, you could actually kind of look at very, very customized top-up loan products and all of that, and then kind of widen your base of customers in the process. These are the few elements that we have been using.
In terms of repayment, design and servicing, where do you see actually the biggest mismatch today?
Sorry, can you just repeat that?
In terms of repayment, design and servicing for this segment of customers, where do you see a big mismatch happening?
Yeah, so I think, the purpose identification is the key there, right? I mean, if you are looking at a working capital loan versus a kind of a more productive loan in terms of asset creation, your repayments need to be aligned to that. Right. I think with a lot of data that is now getting available, the alternate data that is getting available, product design is kind of, coming at the forefront for such customers. But I think essentially the mismatch is the understanding of either the underwriters or the tools in terms of whether it's a working capital versus a more kind of asset product loan.
Great. Thank you so much for that. We move to the next topic, that is on ecosystem partnerships. As scale increases, very few institutions operate alone. Inclusion today is increasing ecosystem-led, bringing both leverage and complexity. So my next question is to Thomas Muthoot. John, since you manage legacy business and you're building something on unique within the ecosystem of Muthoot, my question to you is, as lending and payments increasingly ride on large digital ecosystems like UPI and wallet platforms, what do you design? How do you design actually clear guardrails for scale across partnerships, product journeys, and operations so that growth remains customer-centric, compliant, and controllable, rather than being fragmented or risk-prone?
See, I think over the last decade or so, with JAM and platforms growing and there are payment aggregators all around, there are a lot of cross-contamination, we call it, before the whole concept of partnerships came in and co-lending and all that came in. And over the last maybe 5 or 6 years, I feel platforms out there are not competing with each other now, looking at partnerships where they feel their ecosystems can help other ecosystems as well, and those ecosystems can parallelly cross-pollinate and work together. But if you look at it from a Muthoot perspective, Muthoot FinCorp perspective, and I'm talking from the larger entity in play, we are very clear that with technology, with platforms, with embedded financing, we are able to scale substantially over the last couple of years. I mean, especially the post-COVID period, where there was a huge jump of multiple level of technology partnerships coming in. We felt that scalability has happened substantially, but as an organization which believed in trust of the customer, and customer is a critical aspect for our growth, and obviously we need to take care, as a responsible lender, we need to take care of the customer data as well, where the risk, compliance, the audit, the collection, all that critical aspects are managed centrally by us, and it can't be, it never be outsourced. More importantly, I think if you go deeper, there are a few parameters which we have set in, we have seen, and I was talking to Pawan as well, where I take an example of the QR lending product which we have created with the payment aggregators, the QR payment aggregators, to their consumers, where as soon as the loan the customer shows the intent, the entire compliance, the risk, the collection aspects, all that is managed centrally by us. So literally the customer is our customer for the moment of time he's going to take that particular loan product.
So
And we have added one more level to it, that we don't go out and just start giving money to everybody and anybody. We kind of assess certain regions, certain geographies, certain type of professions, certain type of regions where we feel that there could be learnings to be done. And obviously we use, as Moneybox has also said, that where I think ML and AI is being used to assess the behavior of repayment behaviors, and we kind of keep a very strategic and factual data in front of us before we can kind of proceed to go full blown. And I think look at it in this way, that see, without scale we can't survive in this generation, but risk is something which we will never outsource. And that is integral because it connects to the fact that Muthoot is built on trust. So, yeah.
So, since just highlighting on the point that you mentioned about leveraging credit.
You know too much about us. So
Sorry?
You know too much about me. So,
No.
I knew these questions will come up.
No, so I'm just asking on the point that you just raised in
Yeah.
terms of QR payments,
Yeah.
where leveraging on the aggregators, payment aggregators, you are actually lending. So without seeing the customer, and I understand you're doing a lot of machine learning, what are the guardrails that you've built around it?
So I think one of the things which I missed in the earlier part was that, see, wherever we feel that the customer doesn't need a support,
Okay.
it'll be a fully digital journey.
Okay.
Wherever we feel that there needs to be a customer needs to be handhold. We have 3,600 or close to 4,000 branches across the country, and we've made sure that in these products are given to these customers not more than 10 kilometers from our branches, so that our branches staff go up to these, and we have FOS team as well on ground, where these these teams go down to these customers and kind of show. When you build a product which is kind of faceless, we feel that if you put too much automation, people at that half of the pyramid do not understand and they feel fear. And I keep going meeting these customers, and they feel, and they've taken loans earlier from faceless lenders. But the aspect is that when they say that it is Muthoot, they know there'll be a face in front of them.
Got it.
So, yeah.
Great. Thanks a lot. I think that was helpful. I'll move on to the next question. That is, since we are staying with the ecosystem lens, I want to come back to the system level view. So my question is to Pawan Bakhshi. As inclusion increasingly scales through ecosystem partnerships between banks, NBFCs, fintech, and digital platforms, what are the key system level design elements that allow these partnerships to expand, reach sustainably? How does digital public infrastructure help different players combine their strength to serve underserved segments more efficiently at scale?
So, the challenge of inclusion is such that no one single institution can address it. It needs a model of partnerships, and it's been organic, and this stuff is happening. It's also about leverage. What can you leverage around what? Like, as an example, distribution. Not every fintech in the room has an arm for distribution. So you need specialists on the ground to be able to do that. If we need to lend to at least 1 billion odd people, how many odd originators would we need? Is it 1 million? Is it 10 million? And do we have 10 million? If not, then how do we ensure that where the 10 million exist and the partnerships there? So I think there is a lot of opportunity in partnering, but the key is that today, in my view, the partnership models have a long way to go, right? It takes a lot of effort and time. Try and imagine a small fintech, which is a 3-member team or a 5-member team, trying to engage with a large NBFC or a bank, right? Who do they go and talk to, right? So is it the retail business? Is it the rural business? Is it the agri business? Is it some other business? Is it the tech team? There are lots of these engagements happen, and the time taken could range from a year to 2 years. And in the 2 years, a small fintech would die, right? So it's almost impossible for the ecosystem to grow and thrive unless everybody takes a step or two ahead to say, okay, we are there to help solve this, right? I know the NBFCs, and I know for sure folks at Moneybox, Well, and Muthoot are already engaging with the ecosystem in a different way. But I think there is a lot more that needs to get done, right? So that's one. Two is you spoke about the DPIs. Now our DPIs allow a lot of stuff to happen, right? So while customer KYC costs have gone and declined to about 10 to 15 cents for each onboarding, but why should the customer be onboarded again and again, right? So there could be a data sharing mechanism which I'm sure exists, but I'm not too sure if it's complete and it's recent, which is the CKYCR, and that exists, and everybody should be mandated to put stuff there, right? Because as of now, it's a process. Some people are doing it.
Also ULI.
Or the ULI, right? So there are whole loads of these ecosystem things which will need to get done. I think the other thing is the level of technologies. So there are some people who have technologies which I think are legacy. The others are right up there in terms of, is open source, quick to deploy, and agile. And there's a difference in how do you engage there, right? It's a physical thing because you will need integrations to happen if it has to happen. So is there a role or is there space now for a middleware, right? If you have a middleware and everybody else is connected, like on the ULI as an example, then will that be faster, right? And the other is, assuming everybody accelerates their amount of lending, how do we unlock the capital that needs to be lent? Where's the money, right? So if each of the partners here say, I'm going to do 10,000 crores a year, right? And that's absolutely, I think, doable. It's not far away. Where's the money? How do you raise that, raise the funds? Where are the investors who will come in and step in and say, inclusion is a priority. I'm going to serve those partners who ensure that it is being done, and hence look at it. So I think at several places we see gaps, which it's not that it's an old gap, existing gap, and continue to be. I think there is progress, but I think it needs to get accelerated. Is my sense.
Thank you so much. I think that was really helpful.
Just to add to Pawan's point,
Sure.
And we did discuss about this. I think financial inclusion needs a cultural change in organizations which is doing this, doing financial inclusion, because it's not as easy as you think that when you are on the ground talking to these customers, how do you find solutions to even stretch this further, right? And that needs integrations and partnerships. Not all organizations are open to partnerships because they feel, oh, my data, oh, what is going to happen? Yeah. So I feel, and I'm coming from a legacy organization. I don't know whether not many people know that Muthoot is 140 years old. And on the other end, I myself had to go out and say that, yes, we should be open enough to share data and understand that we are ready to kind of accept partnerships and ecosystem. And I think I had few of my peers who are in the past would have been my competitors who are partners with me right now, right? Yeah.
Right. No, but I'd like to also go back and table another thing. I think financial inclusion is a much used and abused word. I think we should just stop using it. I think what we need to talk about is economic empowerment.
Yes.
And economic empowerment conveys the urgency and the importance of what all of us are trying to do, right? So my urge to you, all of you folks, I mean, I've done it already, is to talk about, so when we talk about our work in the foundation, it's about inclusive financial systems, right? And so I would urge everybody here to take that back and talk about economic empowerment of the vulnerable groups, of women, of all of the other people, to put the context right on why this needs to get done and the importance of this, and hence the acceleration to this end goal here.
Perfect. No, I think definitely we have a lot of senior folks sitting here, policymakers sitting here. I'm sure we should work on something what you just highlighted. Thanks, Pawan and Thomas. I'll just move on. Despite a lot of advances in data and AI, many underserved customers still sit at the edge of formal decision systems. So that takes us to the last topic, that is designing for the underserved, human judgment and AI. From your past experience, Thomas, building digital lending at Muthoot FinCorp, especially for customers with thin or informal documentation, what have you learned about limit of data-driven decisioning, in which moments like human judgment, local context, what you talked about earlier as well, branch level insight becomes indispensable to ensure inclusion rather than exclusion?
See, I was just talking about the fact that organizations like ours who are already in a physical form out there in the market, and in the last couple of years where you've seen UPI transactions and UPI being a very critical aspect of how we transact, this also has some data behind it, right? There's a cash flow system being created in the bank of these customers. There is a repayment structure which is being created through these aggregators. I'm just giving you an example through one of our products, where we feel a customer with almost zero possibility of getting a loan from a bank is now eligible through an NBFC like ours or any of the other lenders who are there, that they have been, there's a history of them which before were invisible. Now there is a data which is there where an assessment is done. Correct. One level of assessment. Then it's a thin line file, right? That's not enough to lend to a customer to be more, to look at it from a risk perspective. We need to understand that there needs to be more insights to these customers. That's where our physical branches come into play, or our forces on ground come into play, where they go talk to these customers. And if you look at it from a microfinance perspective, an RO in a region, in a particular village, when he goes there to that particular community, he knows what is happening in their community. That gives a lot of insights of possible bad debts which are going to come up, or repayment issues, or how these customers are in that community, all that. And now if you look at it, when you add the business aspect of it, when somebody is running a business to it, we've been using technology to assess these customers, stock calculation or AI-based transcripts to understand whether these customers are actually, there are checkpoints on the PO checks which the credit officer does, where in the back of the office, where we are there's a human interaction where the human also comes into play to determine whether these customers needs to go ahead with the next level of the product. But importantly, if you look at it, there are not many customers who have graduated from, say, being a first-time customer with us, starting with 30,000 or 40,000 loan, have graduated because of this system where a technology is enabled, and then there's a physical, in many instances, a FO going and talking to these customers. We feel there's a connection which is being created between them, and we've seen that those customers have graduated from, say, 40,000 loan to a 2 or 3 lakh loan as well.
So being on the ground, definitely the relationship management that the ROs maintain on the ground plays the most critical piece.
I think technology gives us the scale and speed, but human interaction gives us the depth.
Absolutely.
So,
So the phygital thing works very well for you.
absolutely. And when we started the platform, I was in the mind that we need to go use the 4,000 odd branches to scale. See, these customers which I was talking about, even sometimes the branch may miss to go and pitch the product.
Service, yeah.
With data and with technology, we are able to scale at massive levels where the customers which the branch may have missed are now our customers through. But the determination of the branch or the staff at the branch to go and talk to these customers gives us the depth where how far these customers will be with us during this time period.
No, absolutely. Agreed. Fully agree on that. Thank you. Thanks a lot, Thomas, for that. I'll move on to my last question. This is to Mayur. Using AI, real-time data to redesign underwriting and customer journeys, so inclusion is built into the product architecture, not added as an afterthought.
I think very, very important because are you using an AI layer over and above what you've already built, or you're embedding AI in your product, construct, underwriting, and any other services that you provide to the customer? So I'll give you a real life example. In Moneybox, a couple of years back, a small branch of ours, we started seeing a lot of defaults in the cattle segment. When we investigated, so imagine there is a loan officer, there is a credit officer who goes, there is an RCU visit that happens compulsorily, there's a central credit team which talks to the customer before sanctioning a loan. So there are 4 layers already built in, but all human interventions. Right. And then when we analyzed what happened in that branch, so essentially there was one large cattle trader who had like 10, 15, 20 cattle, and he used to lend cattle to potential loan seekers. Right? There is no way I could have identified, because if the branch is involved, the credit officer is involved, the RCU guy, there's no way you can really identify. Now when this technology is there, right, and you have onboarded cattle through that technology, the second guy bringing in the same cattle, he'll not be able to onboard. You're now using that AI as a product construct at the time of onboarding, saying that, okay, fine, this cattle is already onboarded with customer X, how is the same cattle now coming and getting onboarded?
So you've kind of built biometric for cattle as
well. Right? So you do. Second example in terms of underwriting, let's say I've given a loan to a customer who is again a cattle customer. So you do certain calculations in terms of what is the lactating cycle, because that determines the yield of the cattle and then the price at which it gets sold and age and everything. Now let's say if a customer is used to come, let's say after 2 years for a top-up loan, and then when the question used to get asked in terms of what is the yield. Is it the same cattle? That is secondary. But what is the age of the cattle? He says 2 years, which is like lactating cycle, let's say 2 or 1. And when the original proposal was built, the lactating cycle was 2, even then. So how is it? So bolta nahi sir, ye dusri cattle hai. Right. This is a different cattle. He sold the cattle, he's brought a new cattle, right? So you solve for an real underwriting problem there, because you don't need to now go back and check what is the age of the cattle, what is the lactating cycle, because if it is the same cattle, it will show you that this was the cattle which you onboarded 2 years back. The lactating cycle was 2. Now, after 2 years, the lactating cycle is 4. So the yield would have dropped by X percentage. And then you accordingly underwrite or calibrate your underwriting or the loan to value kind of ratios. So it's very important, when you design a product, if you have a technology or an AI or any other layer, if you build that into your underwriting and day-to-day operations, I think it helps a lot. And the products could be different. It could be Kirana, it could be other products. You can design different. Now the technology is there. It's just that you need to be able to invest in those technologies, have have a view that yes, you will be able to, you want to use those technologies and not be a traditional underwriter, because no matter what you said, the technology will give you scale, right? But it will also help you underwrite better and manage your operations better. Absolutely. That's what I feel. Yeah.
I think talking about partnership, I think there's a partnership opportunity already here. I was talking to Pawan, we already fixed a meeting, I think now.
Sure. No, absolutely, I agree. No, I think thank you so much, Mayur. I think that was really helpful. So we come to almost the end of it. Okay, so let me just try summarizing the entire discussion by all the speakers here. First, I would say inclusion is no longer constrained by access or infrastructure. It is constrained by design choices, I would say, right? How we use data, how much judgment we retain, and how clearly accountability is defined in partnerships. Secondly, technology and AI have undeniably expanded reach, but the real differentiator at scale is explainability, governance, and execution discipline, especially when serving first-time and underserved customers. Lastly, successful inclusion models are increasingly ecosystem-led, but the strongest institutions are very deliberate about what they outsource and what they retain control over. Perhaps the most important takeaway is inclusion done poorly creates systemic risk. Inclusion done well creates durable portfolios and trust. We now open the floor to questions or to the audience. We request those who would like questions to be asked briefly introduce themselves with their name, organization, and mention which panelist their question is directed to.
Yeah, hi, good evening all. So I am Professor Kurupesh. I had the MBA in Fintech in one of the premier business school, and I am a part-time consultant also. So my question is directly, I will keep it open only, sorry for that. So how a balance can be struck in a lending product which is economically sustainable when you provide loan maybe to an underbanked segment or an unbanked segment with a no credit history. So one hand you want to charge the higher interest rate, but if you charge the higher interest rate, it will be economically unviable for the person who is looking for a loan.
See, just to start off with...
So there's a competition. There are 3 lenders here. Okay?
No, I'm talking from what I've been hearing all my life. And we've been in that unserved, people who we unintentionally call the unbankables, right? Because they don't have enough documentation or security of any kind to kind of go to an institution to get a loan. See, I feel that's where an organization like Muthoot works very well. Gold, right? Gold loan doesn't need much documentation. You just need a small percentage. And over the last couple of years, you would have seen that the interest rates have significantly come down, and banks have also entered the market. And I just was getting a report that one of the banks, already there are products out there in the market. There are banks which are now focusing gold loans for MSMEs also. So secured product which gives insights to customers. See, India's inclusion started off with gold loans, I feel. And we are going deeper and deeper into the system with the unsecured products so that there is some level of confidence of customers who have started a business to kind of, look at it as a working capital, looking at it as a, expansion of some kind and all that. And as an organization which is always in that affordable sector, we've always seen that a segment of customers are left out in the entire space of things. And all our products, be it gold loan, which starts at as low as 1,000 rupees. We have, any of our products. If you take our housing loan, which is also in the affordable sector, MSME loans, which are all starting at that 15,000 range, where that's where people need the push, right? And as I say that, we are talking about banks as well. We are partnering with banks as well, where we are graduating and hand-holding these customers and leaving at the footsteps of the bank to take them to the next level, right? And many instances there are co-lending as well, where bank doesn't have to put too much money or force to get these people, where we help them kind of take them forward.
Can I just add to this? I'll put a different spin. No, of course. I'll just put a new spin on this, right? And the spin is, it's not a question at all on credit, right? I think it's a question on being, it's about visibility. That am I visible in the ecosystem, right? And it's about dignity. And then after that, once you do that, it's about formalization, right? So as the country progresses towards formalization, more and more of its people will be visible, right? And that helps accelerate the process. And we are hoping, and there is initial kind of evidence which says that the role of technology actually helps in reducing costs. And the credit business is not of giving the money, it's about collection of money. So if you are able to reduce your profiles on risk, where you get more money back and your pricing on risk is lower, and a lot more folks are paying back, the cost of funds will go down, and the cost to the consumer will also go down. Because your ops cost will reduce, your cost of risk pricing will reduce. The whole load of these elements will reduce. So I think it's about visibility and formalization. As that happens, and the role of technology is that of a catalyst, it'll change the entire ecosystem as we know it today.
We'll take one last question.
Probably we can hand over to the lady.
Hi everyone. I'm Joanna D'Souza from Microsave Consulting. My question is open to the panel. Since we spoke so much about inclusivity in the financial product, if you were to design a financial product today for somebody who's entering the formal financial market, what would you have been doing differently than 5 years before?
See, I think the core principles remain the same, I think, in terms of when you look at 5 years back today, because he's still an unbanked customer, he's still new to credit, still, so you will assign a certain risk premium to that. The only difference which I feel is that because now you're able to onboard him, let's say digitally, or with technology, you're able to bring down that cost. So let's say if you had charged him a certain rate of interest 5 years back, you would probably charge him less, because depending on your cost of operations and the use of technology, and if there are more data points around him, let's say if I had only 2 data points 5 years back, but today I have 5 data points, so I'll be able to price it differently, right? But I think more or less, I think the core principles remain the same in terms of pricing a product.
I think I agree. Basically, 5 years ago, the opportunity to triangulate data was much less. A couple of years down the line, it will be much more. So I think at the end of it, if you are able to kind of, optimize your costs and therefore offer a better product proposition holistically to the customer, that will, otherwise the principles do not change as much.
I think over the 5 years, and we were just talking about it, there was a cultural shift of people accepting that we need to work together to reach these customers, and technology just enabled us to reach even further, deeper into these customers. And how we do and reach to these customers, it's different amongst all 3 of us. And we keep pursuing each other. And we were just talking about it, that cattle would be the next future, or agriculture could be the next future. We don't know.
Incidentally, an interesting piece of statistics is that you have 2x the number of cattle loans compared to the number of cattle. Hopefully that will change.
And most importantly, I think ULI, UPI, JAM, whatever you call it, UPI and ULI, which is going to come soon, is going to change. The last 5 years we've seen financial services. ULI and cattle, I'm big fan of ULI for the fact that lot more of land data is being digitized, so there is a central platform where we can access all this. Cattle is one other, please.
So incidentally, let's say dairy is 6% of India's GDP, very big market, right? And the people who kind of service that market, I think they are hungry for credit. And there are like 22 crore bovines, which you can kind of lend. So that data, I think that is a huge asset. It's a moving asset, depending on how you look at it, but it's a huge asset and it's an earning asset for the customer. So it depends on how you kind of monetize that asset to be able to lend.
So I'll just add here, I'm sorry, I'm running out of time. You've asked a really important, question. And my sense is what's happening now is product development is moving out of ivory towers into the field. So a lot more people sitting here and sitting here are spending time with the prospective customers to understand their lives, their cash flows, the way they live, what kind of families that they have. And based on that, products are being made. Right? In the olden days, you had a savings account, and a savings account is a savings account is a savings account for the last 150 years. Not changed. Right? But on credit products, where you're talking on segments for people, for the kinds of communities and kind of segments, that's a huge big change. So it's about personalization, it's about customization, it's about you spending time on the ground with your consumers to understand where the shoe is pinching. That's changing.
I think just to end this, what I feel as an Indian, we need to be proud for the fact that PR ULI is going to change how the world sees financial inclusion. And we need to be proud that the country, India, is going to be the front runner in this, and it will help organizations like Gate Foundation, who are in Africa and in many of these countries in Latin America, where they are still questioned, how can we reach the last mile? And these are the products which are there, and the next 5 years is going to be even better. Yes, absolutely.
No, I think this has been almost 125 or 130 years of experience. People are sitting out here. So I think if you allow them for another 3-4 days also, they will continue with different topics. So I think, thank you so much. I think you guys have been a fantastic panel. Really appreciate. Over to you, ma'am. Thank you.
Thank you. I think we had a lot of refreshing insights onto it. What a fresh perspective to so many things. We were talking about AI in the morning, and now we've come down to cattle and how we are going to fund things like these. Okay. Now I would like to request our moderator, Clemenston Varghese, co-founder Dwara Money, to please extend a token of gratitude in no particular order to Mr. Mayur Modi, co-founder and co-CEO Moneybox Finance Limited. Ladies and gentlemen, can we please give a huge round of applause? And to Mr. Kartik Mehta, co-founder and managing director, Pahel Financial Services Private Limited. Mr. Pawan Bakhshi, India Lead Inclusive Financial Systems Gates Foundation. Mr. Thomas Muthoot John, Executive Director, Muthoot Microfin with... And now I would like to request Mr. Shashank Shekhar, co-founder and head of consulting at the Digital Fifth, to come up on the stage and extend a heartfelt gratitude to Clemenston Varghese for moderating this session successfully. Gentlemen, I would request you all to please come ahead for a group photograph.